Hey there, quick game. Open your banking app. Look at your balance. Now ask yourself one slightly uncomfortable question. Where did those numbers actually come from? Because here's the strange truth. Most of the money you've ever used was never printed. Never mind. Never dug out of the ground. It was typed. Let me introduce you to Bob. Bob is a normal guy. Normal job. Normal life. Normal dreams that cost way more than his savings. One day, Bob decides he wants to buy a house. He checks his bank account. Uh-oh. He has $10,000. The house costs $300,000. Bob does not panic. Bob goes to a bank. He sits across from a very calm person in a suit who drinks coffee like nothing exciting is about to happen. Bob says, "Hi, I'd like to borrow $290,000. The banker clicks some buttons, nods, types some more. And then something magical happens. Bob's bank balance jumps. Suddenly, Bob has hundreds of thousands of dollars. No trucks delivered cash. No vault was opened. No billionaire had to lose money for Bob to gain it. The money just appeared. This is the moment where most people think, okay, that sounds illegal. It's not. This is how modern money works. When banks lend money, they create it. Not from gold. Not from savings. From accounting. The bank didn't take $290,000 from someone else's pile and hand it to Bob. It created a new deposit in Bob's account and a loan on its own books. 2 entries. 1 asset. 1 liability. Boom. New money. That's why people say money is created out of thin air. But it's not pure magic. It's conditional magic. Because Bob now owes the bank. Every month, Bob sends money back. Interest included. And that interest? That's how the bank gets paid for the magic trick. Now let's zoom out. If banks create money when they lend, then who creates most of the money in the economy? Not governments. Not central banks. Commercial banks. When people are confident, borrowing increases. More loans. More money created. When people are scared, borrowing slows. Loans dry up. Money creation slows. This is why the economy feels like a mood ring. Money expands when people feel optimistic and shrinks when people panic. Now you might be thinking, wait, if banks can just create money, why can't they create infinite money? Because there are rules. Lots of them. Banks have to worry about capital requirements, regulations, risk, and whether Bob can actually pay them back. If Bob looks unreliable, the magic doesn't happen. No loan. No new money. So money creation depends on trust. Trust in borrowers. Trust in the economy. Trust that tomorrow won't explode. Now let's bring in the central bank. This is where things get spicy. Central banks don't usually create money the same way banks do. They don't hand out mortgages to Bob. They control the environment. Interest rates. Liquidity. Confidence. Think of the central bank like the thermostat in a house. They don't cook the food. They don't decide the menu. They just control how hot things get. When the economy is cold and sluggish, they lower interest rates. Borrowing becomes cheaper. Banks lend more. Money creation speeds up. When the economy overheats, they raise interest rates. Borrowing becomes expensive. Loans slow down. Money creation cools off. So central banks don't print most money. They make it easier or harder for money to appear. But sometimes things go very wrong. Like during a financial crisis, or a pandemic, or a moment when the economy freezes like a deer in headlights. People stop borrowing. Banks stop lending. Money creation collapses. That's when central banks pull out the big, weird tools. They start buying assets, government bonds, financial securities. They pay for them with newly created money. Yes, this is literal money creation. New reserves, new balances, still mostly digital, still mostly numbers, still not a pallet of cash. This is what people mean when they say the central bank is printing money. It's not a printer going brrr. It's a spreadsheet going click. Now here's the part that feels unfair. When new money enters the system, it doesn't go everywhere at once. It enters at specific points. Banks, financial markets, government spending. The people closest to those points see the money first. Asset prices rise. Stocks, real estate, investments. Wages? Those usually lag behind. That's why money creation can quietly increase inequality. Not because someone is evil, but because money flows like water. It reaches the top first. Now let's pause and ask the big question. If money can be created so easily, why doesn't everyone feel rich? Because creating money doesn't create stuff. It doesn't magically add houses, food, energy, or labor. Money is just a claim on real resources. If too many claims chase the same amount of stuff, prices rise. That's inflation. Inflation isn't money going bad. It's money showing up faster than reality can keep up. So money creation is powerful, useful, dangerous, necessary. It keeps economies moving. It prevents collapses. It funds growth. But it has limits. Push it too far and trust cracks. And once people stop trusting money, they stop accepting it. They stop saving it. They try to escape it. That's when numbers stop behaving nicely. And here's the wildest part. Most people never see this process. They just see, I work. I get paid. I spend. But underneath that simple loop is a constantly expanding and contracting system where money is being born, multiplied, and destroyed every day. Yes, destroyed. When loans are paid back, money disappears. The numbers go down, the opposite of creation, which means money isn't permanent. It breathes. It expands and shrinks with behavior, confidence, fear, policy, decisions made in quiet rooms. And once you realize that money isn't a fixed pile but a living system, you start seeing why economies feel unstable, why booms feel exciting, and why crashes feel terrifying. Because the thing we all depend on is mostly built on trust, rules, and timing. And that raises one final uncomfortable thought. If money can be created with a loan and destroyed with a repayment, then the real power isn't cash. It's the ability to decide who gets access to money creation in the first place. And that's where things get interesting. Because access to money creation is not evenly distributed. Bob had access because the bank trusted him. Good credit, stable income, predictable life. Someone else with the same dream but less stability? No loan. No magic. So money isn't created for everyone equally. It's created for people and institutions the system considers safe. That's why businesses with good connections get cheap loans. Why governments can borrow trillions. Why struggling people often face the highest interest rates. Money appears where risk feels low. Now let's talk about what happens after money is created. Bob buys the house. The seller gets paid. That money moves into another bank account. The seller might invest it, save it, or buy something else. The money starts circulating. Every time it moves, it creates activity. Jobs, spending, growth. This is why economies love borrowing during good times. More loans mean more money. More money means more activity. More activity feels like prosperity. But remember, this is borrowed time. Because every dollar created through lending comes with a repayment attached. At some point, Bob has to pay it back. And when Bob pays back the loan, the money disappears. Not transferred. Not recycled. Deleted. The bank reduces Bob's loan balance. Bob's account goes down. The created money is gone, which means money is constantly being born and destroyed. Quietly. All the time. That's why economies can suddenly feel tight. Not because someone stole the money, but because money stopped being created faster than it's being destroyed. This is where recessions come from. People stop borrowing. Loans dry up. Money creation slows. But repayments keep happening. Money exits the system faster than it enters. Suddenly, everyone feels poor at the same time. And here's where central banks step back in. When they see money disappearing too fast, they try to counteract it. Lower rates, inject liquidity, buy assets. They try to replace disappearing money with newly created money. Not to make people rich, but to keep the system from choking. Now here's the part that makes people angry. When central banks create money, it doesn't land evenly. It flows into financial markets first. That's why stock prices often rise even when everyday life feels hard. It's not because the system is mocking you. It's because money enters through specific doors. And those doors lead to assets first. That's why people who own assets benefit early, while people who depend on wages wait. And wait, this is also why just printing money is not a free lunch. Yes, you can create money, but you can't create real things just as easily. Factories, skilled workers, energy, time. If money grows faster than reality, prices adjust. Inflation shows up. Suddenly, the magic feels less magical. Now let's address the conspiracy-sounding thought. If money is just created by banks and central banks, isn't the whole thing fake? No, it's abstract. Big difference. Money is a tool, a measuring stick for value and exchange. It works as long as we agree it works, the same way points work in a game, or grades in school. They're not physical things, but they shape behavior. And money is one of the most powerful behavior-shaping tools ever invented. Now, here's something that might surprise you. We've always done this. Even in gold-based systems, banks issued more claims than gold they held. As long as not everyone showed up at once, the system worked. Modern money just removed the gold costume. What changed wasn't honesty. It was scale, speed, flexibility. Now money can expand instantly to match the needs of the economy and shrink just as fast. That's powerful. And scary. Because power without understanding feels like chaos. Most people never learn this. They're taught money is scarce, fixed, and static. Earn it. Save it. Don't ask questions. But in reality, money is dynamic. It responds to incentives, to fear, to confidence, which is why understanding money creation changes how you see everything. Debt stops being just bad. It becomes context. Inflation stops being mysterious. It becomes mechanical. Crashes stop feeling random. They become predictable reactions. And the biggest shift? You stop asking, where did my money go? And start asking, who stopped creating it? Because that's usually the answer. Now let's circle back to Bob one last time. Bob didn't get rich because money was created for him. He got access. Access let him act earlier than others. Earlier access compounds. Over time, small advantages grow. That's how money creation quietly shapes inequality. Not through villains, through rules. Now imagine if access were different. If money creation favored different groups. If lending rules changed. If incentives shifted. The economy would look very different. Which means money creation isn't just a technical process. It's a political one, a social one, a moral one. Deciding who gets access to newly created money is deciding who gets a head start. And that decision happens every day through policies, regulations, and risk models. Usually without headlines. Usually without public debate. So the next time someone says money is fake, what they really mean is, I don't understand who controls it. And that confusion is understandable. Because the system is invisible by design. It runs quietly in the background so daily life feels normal. But once you see it, you can't unsee it. So, in conclusion, money today isn't printed like posters or mined like gold. It's created through lending, guided by trust, rules, and policy, and destroyed when debts are repaid. Banks create most of it. Central banks manage the conditions. And access determines who benefits first. Money isn't a fixed pile. It's a living system that expands and contracts with confidence. And understanding that doesn't make you cynical. It makes you aware. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.